All right, so Steve Cohen, he kind of talked about a possible correction, retesting the April lows, pulling back about 10 to 15%. I want to ask you, do you think there's merit in that thought and that thesis? And if so, what would be the catalyst? It seems like it would have to be a pullback in tech that leads to a decline like that.
So we don't see an imminent recession on the cards. And we're coming off the back of a very strong Q1 earnings season. CPI is moderating, jobs are holding up. If we do test the levels of recession over the next couple of quarters, we think it might be a narrow technical recession. But really, tech at the moment is riding some very strong tailwinds. And this is an area of the market that was grossly oversold in Q1. And although we've seen a very decent pullback over the last couple of weeks, this is where you're seeing secular growth. And I agree with Stephen Cohen's assessment that we are going to see economy-wide slower growth. But that's where you really want to be invested in companies that are riding the wave.
I don't want to interrupt you, but the economy and the markets are two different things. He mentioned the chances of recession, but he also talked about a correction in the markets, a 10 to 15% pullback. So do you see the potential for that? And if so, what would cause it in your mind?
I think if we saw the China-US deal, sort of the relationship there worsen significantly. I mean, the 90-day truce has really removed one of the key tail risks from the market. But also potentially the economy and the recession. So if that were to surprise to the downside, I think we could possibly see some bad news baked in there.
All right. What's your take on the bond market? We just talked about it a bit ago. Right now, we're seeing the 2-year top 4%, the benchmark at about 4.5%, the long bond very close to a 5% yield. Do you think that has the potential to create competition for the equity market?
So if we were investors in fixed income, which we're not, so certainly those short duration treasuries would be our pick of the mix. 4% yield is enticing, but we've got to remember that Fed cuts in the second half of this year are possibly on the cards. We think more likely than not. And earnings growth is looking pretty decent for the S&P right now. You're looking at about 7% for 2025. You can find much higher earnings growth rates in select pockets of those markets. Once you add in dividends, you're looking at a total return proposition that's almost double. So we think that the equity setup is very decent, but it is a stock picker's market at the moment. The opportunity after the market's rise over the last couple of weeks is firmly at the individual stock level.
All right, so you're mentioning the Fed. We're going to hear from Jay Powell in D.C. coming up later on this morning. The signaling from Jay Powell, how do you see that impacting the market? And again, specifically the tech trade, just because of the large concentration of tech names when we're looking at the S&P and the NASDAQ.
So we think that Powell's going to remain in wait-and-see mode. Certainly, we've got retail sales and PPI out today, which will inform his discussion. But it's quite early to see any of the ripple effects from tariffs certainly come through in these inflation numbers. We will closely be watching, as he will, whether PPI follows the trend of CPI lower. But we expect him to remain in this data-driven wait-and-see approach. As it pertains to the tech rally, well, that's for some decent cause. We've seen a fundamental pivot in the Trump administration stance towards exporting U.S. technology. A couple of weeks ago, we were thinking about a shrinking market, essentially restricting the sales of U.S. technology. And now we have Trump almost acting as a sales representative for NVIDIA. And the implications of this, we think, are pretty significant, and that will take a while to be priced in.